Hi, I'm Tracy Sofra and welcome to the Women of Wealth podcast, dedicated to helping women achieve financial independence and thrive in every area of her life. So in today's episode, we're going to be diving into the unique financial challenges and opportunities that women over 40 face and how we take control of our wealth building journey and our confidence when it comes to building wealth. So let me just outline this. As women, we often juggle, we've got so many balls in the air, right? Whether we're professionals, mothers or both, daughters, caregivers or all of the above, we do fill in so many different roles. But today we're going to focus on you and your financial future and how to set yourself up for success in your 40s, 50s and beyond. So let's get started. Alrighty, first thing I want to talk about is using your catch-up contributions. This is one incredibly powerful strategy that not a lot of people know about. It is super, and love it or loathe it, super is around to stay, so let's make the most of it. I always say to all my clients and everyone that I speak to, super needs to be taken seriously. It is one of the biggest investments that you have if you're in full-time employment, part-time, casual, what have you. 11.5% at the moment is what needs to go in there. Which is called the super guarantee. Over and above that, you're able to contribute yourself. So one of the type of contributions that not a lot of people are aware of is called catch-up contributions. Now, I know that for many women over 40, retirement may feel like it's just around the corner, but don't panic. Okay, it's never too late to start building your wealth. And whether you've been focusing on raising a family, which, you know, early on, I mean, women are having children much later in life. I know I had my kids in my 40s, but whether you're focused on raising a family, building a career or doing both, you may just have not prioritised your super. And now there's time to catch up. So how can we play catch up with super? Well, it's called catch-up contributions. Pardon the pun, it is called catch-up contributions. And really, just to let you know, the super system is set up so it can assist you in doing this. So if you have, now let me just talk about the two main types of contributions. One is concessional, which is made up of your super guarantee, where your employer puts in the amount they have to, currently at 11.5%. And any salary sacrifice you put in or after-tax contributions is also part of the concessional group. That is capped at $30,000 a year. So if one year, if say in the last financial year, 23-24, because we're in the 24-25, you didn't reach that cap of 30,000, you can use whatever you didn't use. Say you got 25 in, or say you got 20 in. If you got 20 in last financial year, and that is made up of your employer and your own contributions, you've got another 10 that you can catch up on. So you didn't max it in the last year. So this year you've got your 30 cap and 10 from the year before, which is termed catch-up contributions, and you can claim that catch-up contribution in the current year without exceeding your caps for the year, because it's catch-up from the year before. I hope this is all making sense. You can use up to 5 previous years, and so it's a rolling 5 years. So the last 5 years, or the very first of the 5 years, will drop off if you don't claim it. So let me give you a bit of an example that I've written down here. So for example, 2019 and 2020, so the 19-20 financial year, any unused cap amount, if that's not used by the 24-25 year, which is this financial year, it will expire. So it's a rolling 5 years. And the best thing to do is, if you're going to use catch-up contributions, go back to the oldest one to grab that. Otherwise, it's going to expire. And the current year that you're in, if there's any unused, that becomes the 5th year. Hoping this is making sense. So using catch-up contributions is a really powerful way to boost your super, to catch up on anything that you may have missed out on, as women do, in terms of raising families, being caregivers, or having time out of the workforce. So it's a really powerful way to do that. Other considerations, obviously, are salary sacrificing into super. That is when, let me explain this because there's a bit of confusion around that. Salary sacrifice is where you're sacrificing part. So exactly as it says, you're sacrificing part of your gross wage, wealth, gross is before tax, and saying to your employer, look, say you're receiving $850 gross a week, and you're saying to your employer, can you put the 50 into super and only tax me on the 800? That's salary sacrifice. You're getting the tax benefit of that at source every single pay period. If you decide that's not for you because you're finding it hard to juggle what your take-home pay is, you can do it after tax. So you can take your income the way that you receive it from your employer, and then every month or probably monthly is the easiest thing to do. Make that contribution yourself. What then? How do you get the tax benefit from that? When you go to lodge your tax return at the end of that financial year, you will receive a notice of intent to claim from the superannuation fund that will say, hey, Trace, you've contributed let's say $5,000 to your super. Do you intend to claim that? And obviously it's a trigger for you to remember, yes, you're going to claim it, and notify the super, the intent to claim form. You sign that so the super fund knows whether they're going to tax it or not. Because if you claim, they're going to tax it inside your super fund at 15 cents in the dollar, and that's pretty standard. But once you claim it in your income tax return for the end of that financial year, that's when you get your tax benefit, as opposed to salary sacrifice at source. So the benefit is always there. It's just a timing thing, basically. So whether you do it at wages time in terms of salary sacrifice or after tax, you're still going to get the tax benefit. You won't miss out. Just a timing thing. So making sure that you're looking at either salary sacrifice or after-tax contributions as well, and you can top it up that way. The other really big type of contribution that there is called a non-concessional. So that was concessional. Non-concessional is where you've got a lazy 100 grand sitting around, or not that a lot of people do, but any amount of money, 20, 30, 5, 10, whatever it might be, you might get an inheritance or windfall gain of some sort, and you can pop it into your super if you're close to retirement, and that will go in tax-free. So you don't get to claim the non-concessional, and because you don't get to claim, the tax office won't tax it going into your super fund. So it's completely tax-free going in. That's another form of topping up your super. You would probably most likely do that as you get closer to being able to access that super, because super, as you know, is preserved until such time as you reach preservation age and sign a retirement declaration from work. That's generally age 60. If you're 65, you don't have to sign a retirement declaration. You can simply access your super, but we'll talk about that a little bit further in some of my other tips of how to do that. So the next thing is, talking about building long-term wealth. Well, let's talk about long-term wealth. We know that investing wisely can make a huge difference in achieving financial independence. But what is investing wisely? These days, there's so much noise, so many opinions, and so many people telling you. I'm sure they're all telling you, do this, do that, do this, do that. But you got to stay to the tried and true methods of building wealth. It takes time, it takes patience, it takes having a clear head, and it is following, again, as I say, tried and true methods. There is no get quick rich schemes, and if they say there is, they're lying and they just want to sell you something and take your money. So stay away from that sort of advice. So the beauty of starting in your 40s is that you still have time on your side to let your investments grow. So one of the best ways to build wealth over the long term is through diversifying your investments. What's diversifying? You all know that. It's the same thing when you've heard about, don't put all your eggs in one basket. That's exactly what we're talking about. So while investing in shares is definitely one option and a great option, don't forget the power of property. Property is a very powerful asset class that will grow over time. So real estate in Australia can provide amazing capital growth and rental income. Just like shares, it will provide capital growth. So if you buy a share for $4.50 today, you're hoping it's going to be worth 10, 12, 15, what have you. I often talk about Commonwealth Bank shares because it's one of my favourite stocks. When the pandemic happened on the 20th of March 2020, I think off the top of my head, I think it was about a $95 share. It dropped to 52 in the middle of the pandemic. The sale was on, and now it's, I think last I looked, it was about $156 share. That's capital growth. That's what we talk about, capital growth. And over the last coming up 5 years now. It paid dividends. That's an income return. So shares will do that. Property will do that. They're very powerful in being able to provide long-term growth for you. Wise investments to do. Tried and true methods of investing in asset classes that have been around forever and a day, and we know exactly that they're going to provide us with the returns, provided we're sticking to blue chip shares. Don't invest in anything you don't understand. Don't take unnecessary risks that you don't need to take, and sticking to the principles of tried and true methods of investing in property once again, and holding and having a long-term perspective and holding a long-term position. So yes, property will also give you growth and rental income. So income. And if you are in a position to invest in direct property, it's an excellent option to add to your portfolio, obviously. So don't overlook that. But also don't overlook, coming back to your super, don't overlook the power of your super. Many super funds, all super funds really, allow you to diversify the way that you invest. They have options of shares, bonds, properties in terms of REITs, real estate investment trusts, and they are what we call listed. They're listed on the stock exchange. And also these days, super funds allow you to invest in ethical or sustainable investment options as well. And that's a huge growth area for a lot of ladies that I'm talking to. They want to connect with their values and what they value, and how that value is represented in their investments, and particularly through their super. So that makes a lot of sense as well. But the key is to start now. Okay, don't panic because you're 50, 40, 50 or beyond. Anything you do now is going to be more beneficial than doing nothing. Is it not? I mean, stay doing nothing and you get nothing, but start doing something now, and a massive difference will occur over time. So start doing something now, even if it's small. The magic of compound is real, I promise you. And the earlier you begin, the more your money will grow. The other big area is balancing debt and wealth building. So one of the big questions I often get from women when I'm talking to them is, and the question that they ask me is, should I focus on paying off debt, or should I start investing, saving and investing? This can be a tough one, and it really depends on the type of debt that you've got and the type of debt you're carrying, obviously. So if you've got high interest debt, such as credit cards and personal loans, personal loans will be around the 12, 13, maybe 15, and credit cards, as you know, can be anywhere between 22 and 25 and so on. The smart move is to pay off that high interest debt as soon as possible, because the interest rates are usually higher than what you expect to get as a return from your investments. So clearing those debts quickly should be your first priority. Once you've taken care of that high interest debt, it's time to focus on building wealth. And this can include setting aside money for retirement, obviously, contributing to your super, as I've mentioned before, and even building an emergency fund. So when we talk about an emergency fund, best practice is 3 to 6 months of your sort of rainy day money that's accessible. And what that does is it gives you peace of mind to know that if anything came up, you've got access to those funds, and it really reduces financial stress dramatically, to be quite honest. If you're closer, if you're, not 40 or 50, or you're further beyond, I always say, and I get the question, should I be building my cash cushion, which is the word I was looking for before. Should I be building my cash cushion trace first before I invest? If I'm further down the track, I would just start investing. Even though cash cushion is best practice, because the time is limited, I would start investing as soon as possible. And you can always access those funds if an emergency did come up, but at least you're using the time that you've got and getting the benefit of compound interest over time. So I would probably look at it in that way. If I was 40, I'd probably build a cash cushion first and then invest, or try and do them both at the same time. But if I was lacking time, I'd probably look towards investing it first and getting the benefit of the power of compound over time. The other thing that I want to talk to you about today is creating sustainable income streams for retirement. So as you near retirement age, one of the key goals is to create reliable income streams that support your lifestyle and support your income needs when you're no longer working full time. So one of the biggest questions I often ask clients is, if you were to stop working today, what assets have you created? Can you have a look at your assets and look at the assets you've created that's going to put money back in your pocket? Because we all work, and we all work with our hands, and it's called personal exertion. Working with your hands, meaning you don't necessarily have to, be a trade, a carpenter or a builder or anything like that. But working with your hands means you've got to get up every morning out of bed and you've got to do to earn the income. But when time comes to stop doing that, what assets have you built that will then put money back in your pocket? Assets such as shares that provide dividends, assets such as properties that provide rental returns. So the main thing here is it's not about waiting till retirement to do that. This is a long-term strategy. So you need to be thinking about this now. You need to be thinking about investing wisely, as I said at the opening of this podcast, and looking at property, looking at shares, and taking your superannuation seriously. They're really the three biggest areas when you're talking about building wealth. And the earlier you set up these income streams, the more sustainable your wealth will be in your golden years, obviously. So consider dividends from Australian shares, and it's a great way to supplement your retirement income, and it's very tax effective because in Australia, our dividends, most companies will pay dividends that have what's called a franking credit, which means that the company that's issued that dividend to you has paid the tax on that dividend to the Australian Tax Office, and that tax credit is passed on to you. So the tax is already paid on that income, and that's very, very tax effective. When you're looking at shares, blue chip shares are the ones that you want to be looking at. Every week I probably get one or two queries about blockchain, cryptocurrency and Bitcoin and all of that sort of stuff. I feel that firstly, I don't personally invest in anything I don't really understand, and I don't like taking unnecessary risks that I don't need to take. And so if you're in your 40s, 50s and beyond, my question back to you is, do you need to take that particular risk when you know that something like the Australian share market has returned about 13% over the last 124 years? We've got 124 years of data there that tells us what it's been doing, that we can see works, property that we know works versus blockchain, Bitcoin. And I'm not bagging out any of those things. I'm simply saying, from a risk and return point of view and a timing point of view, what do you think is a better way to go? What would that be if you were to weigh that up between the two? And that's what I would pose back to you to think about. And finally, in terms of building that wealth, when we come back to, so there's property, there's shares, and then there's superannuation, and investing that wisely as well. As I said, regularly reviewing your super, knowing how to review that super, knowing what to look for, and making sure that it is aligned with your risk profile. All of the beneficiary nominations are in there, looking at the fees, looking at the investment options, really critical things to be looking at when you're considering your super. And finally, let's talk about creating generational wealth. And that's an interesting concept, isn't it? Let's talk about something near and dear to most of us, and that is really about leaving a legacy, isn't it? Creating generational wealth means passing on financial security to the next generation, whether it's through super, because you've got to nominate your beneficiaries, or investments or property, or simply teaching your children about financial literacy. How many of you are pulling your kids aside? How many of you listening to my podcast are thinking to themselves, gosh, I've got to get my kids to listen to this, or I've got to get my kids onto this sooner than later. And if you don't have kids, I've got to get my nieces or nephews or my godchildren or whatever it might be, my girlfriend's kids, to listen to this. You might want to consider setting up family trusts, which you can do, or even investing in assets that will continue to grow, like property. So this is about leaving legacies. If this is important to you, these can help protect your wealth and ensure that it's passed down to future generations in a tax-effective manner. And you really need good advice when it comes to setting up trusts and passing assets down through the generations. Good advice is key here, and it's I can't stress that enough in terms of getting really good advice. And a crucial part of generational wealth is education. really, really important because somebody said to me once, it takes one generation to build it, another generation to enjoy it, and another generation to lose it. And they will lose it, I promise you, if they're not financially educated. If you don't understand money and if you don't know how to manage money, you will lose that money without a doubt in my mind. So financial education and passing that down to the next generation is crucial and is key. So make sure your children understand the basics of managing money, of investing and saving for their own future. So the more knowledge that you share, the better equipped they'll be to maintain and grow the wealth that you've built and pass down to them. So as I wrap up today's episode, I want to remind you that it's never too late. I get this often. It's never too late to, change and take charge of your financial life. Any step forward is a step in the right direction versus staying in the same place. If this is something you would like to explore, then make sure you book a call with one of our strategists. All you need to do is go to wowwomen.com.au and click on the link to our programs and set up a time. Best of all, the call is absolutely free. So whether you're in your 40s, 50s or beyond, there's plenty of time to make meaningful changes to your wealth building strategies. And remember, start small, stay consistent and invest wisely.